Hi, this is Hyperwave. I am Leah Wald. We have Tyler. We have missed you. So I thought, we'd both be a little goofy. I don't know what you guys think about my shirt. It's pretty ridiculous. And you have your co-host Thor here today as well. So we're going to start off nice and fun. Tyler, missed you. We're going to do options today, no?
Yeah, we're going to do options part 2 today, or D, E, and F. We started with options A, B, C, just the real basics. What we're going to talk about today is a little bit more complex in understanding options, but we're not going to spend a lot of time, maybe 30 minutes max. We'll take a look at Bitcoin at the end of this because we haven't talked about it. I haven't seen any need to talk about it since our last vlog because nothing's really happened. We're still trading between 62 and 6,500 after popping up from the lows, and I'll give you my thoughts on all of that at the end of this show. But let's just review very quickly about options. An awful lot of people were asking if we would do more because they had heard about them, but they've never ventured into it. And we talked about it, Leah and I, in the context of a defensive strategy and also a tax strategy. But to understand those kind of strategies, either offensive or defensive, or when and how you use them for tax advantages, you need to understand the basic principles, just how they work. So we just talked about buying puts or buying calls. And remember that what we're talking about is each option. If you buy one option, that gives you the right to buy 100 shares of stock if it's a call. If it
Hey, Tyler, I lost you. Live chat, if you guys lost Tyler too, let me know. You guys have to deal with this shirt in the meantime. Tyler, just keep talking, and if it comes back up, then I'll let you know. All right, Tyler's coming in and out. Yeah, I don't know how he curls up like this, like intensely, because he's such a massive dog. No sound? Yeah, okay. On a scale of 1 through 10, legitimately, how ridiculous is this? Hey, Ty, you back?
Yeah. How's that?
Perfect.
Okay, good. So if you want to buy the right to buy 100 shares of stock, that's called a call. If you want the right to buy 10 calls, that is 1,000 shares of stock. And a call is specified by what you're buying. And we're going to look at Tesla stock today because it's in the news so much and it's very, very volatile. Therefore, I'll be able to make my points about options with Tesla. And then if you want the ability to sell 1,000 shares of a stock, and let's call it Tesla, you can do that by buying 10 puts. Each put is worth 100 shares of stock. So it makes it very easy to do all the math on options. Everything is in 100 share pieces. Okay, so what we're going to do is I'm going to jump onto Fidelity. It's just another brokerage firm that allows you, once you've set it up, to buy and sell options. And to do some other things that we're not going to talk about until we get to options part 3, which is writing options. All we're talking about now is buying and selling calls and puts, which should be 90% of what you need to know to understand how you use them defensively and offensively. Okay, so I'm going to do a screen share very quickly. And what we're going to do is we're going to just pull up Tesla option series. And for those of you who haven't taken the time to look at this on your own brokerage accounts, they will be very similar. And let's just review what we're looking at here. Up here is Tesla stock, TSLA. This is the last price of Tesla. I will update and make sure, $335.38. Now it's $336.19, down $2.50 today. Now these might be very small numbers, so you might have to scooch up closer to either your iPhone or your iPad or your computer. But you don't really need to see the numbers. I'm going to point things out, and I will be very careful to specify what numbers we're looking at for those that aren't looking at the audio, at the screen itself, but are going to listen to our audio podcast later. So here's the way these things work. A lot of numbers. It looks real confusing, all kinds of arrows up and down. It's not. It's very, very simple. Remember what the price of Tesla is, $336. Let's just freeze it at that point and just think of it in terms of somewhere around $335. Now, if you come down to this top area, this is August the 17th. That's tomorrow. All of these will expire tomorrow, 1 day from now, because options expire on the third Friday of each month. But, for example, here are August 24th calls and puts. Here's the calls. Here's the puts. You don't need to look at the numbers now. Just see how this thing is set up. Calls and puts for August the 17th, 1 day from now. This is 8 days from now. In other words, 1 week further on, August the 24th of 2018. They expire on that day, which will be a Friday, and they will expire at a certain time during the day, which you've got to know. We're not going to go into those kind of logistics and details now. Just conceptually understand what I'm trying to say. Here's another one for 15 days away. Here's another one for 22 days away. Okay, so those are the simple things. Now up here at the top, it shows all of the strike prices. When I'm talking about a date, the date is shown in the middle here, and it's also shown up along the top. August 17th, August 24th, August 30th. So you don't have to scroll up and down. All you do is click on it. So here's September the 21st, and then you apply it, and September the 21st comes up. Okay, so now just back to what we were doing. We're going to stick on this 1 day option, just so you understand some real important principles of how options work. Now, here are what are called the strike prices of the options, and that's starting at $325. Then it goes up by $2.50 for the next option. Strike price means what you are willing to buy the stock for. And this allows you to buy it, meaning 100 shares of Tesla, at $325. Well, it's $336 right now. So that's $11 less than it's costing. If you were to buy 100 shares of Tesla stock, that would be $33,600 and some pennies, right? Just 100 shares times 336. 10 shares would be 3,300. So 100 shares would be 33,600. So I can go into the marketplace at this moment and buy 100 shares of Tesla at 336. But this option allows me to buy 100 shares at $325 per share, which is only $32,500, which is $1,100 less than it would actually cost if I bought the shares. So how's that possible? Well, we haven't talked about what you've got to pay for that right. And that's over here, the bid and the ask. So let's think about this for a second. There are people out there, there have been 66 of these calls traded today. This is the volume column. The bid right at this moment is $11.20. Somebody's willing to pay $11.20 to buy that option. Well, that makes some sense because they're willing to pay $1,100. One of these options costs $11.20. So if you're buying one option, which is worth 100 shares of stock, that is the same as $1,120, right? $11.20 times 100 shares is $1,120. So I can buy this option, 325 option that's going to expire tomorrow, and I have to pay $1,120 to do it. Now, why does that make any sense? Well, if you add $1,120 to the strike price of $325, that equals $336, which happens to be exactly where the stock is trading. So you're not gaining anything by buying this option unless what? In other words, you're not paying a premium above the value of this transaction, but you've got 1 day for something exciting to happen. It's 2:45 in the afternoon Eastern time right now, which means you've got an hour and 15 minutes for Tesla stock to go up or go down or stay the same. And there's people that believe that they can buy this 325, and if it just goes up $5 before the close, and Tesla moves very quickly, it's already down $2.55 today. But if it goes up $5 from here, then the price will be $341, and you've got a total dollar cost in at $336. So you're going to make $500 by only paying $1,120 in less than a day. That's if it goes up $5. Okay. It's very difficult to use a 1 day sort of a period because it's so close. There is no what's called a time premium. And now I'm going to illustrate what that means. Okay. So let's think of something else here where there is a premium. Let's go to this strike price, which is $335. Remember, there's only 1 day left. So you're going to buy this, and if you don't do anything, it will expire worthless tomorrow unless the price stays over $335. Well, it's trading at $336 right now, and this gives you the ability to buy this at $335. So once again, you've got almost a dollar. Instead of, you've got $1 per 100 shares or $100 advantage of buying this $335. But what will it cost you? Come over to the bid and the ask. Now, this is the same day that the 325s expire on, which is 1 day from now. This is 335, which is still less than 336, but you've got to pay $410 or $4.10 per share, even though this is only $1 less than the price of the stock. So there's a time premium, even though it's 1 day from now, built in because we're so close to the strike price. We're within $1 of the strike price, 336 versus 335. And there are 2,441 of those contracts that have traded, compared to only 66 of that one that's way under at $325 strike price. Okay, so let's try to just do the math on this. What will it take to get your money back if you pay $410 for the right to buy 100 shares at 335? Well, 335 is $1 less than it's going. So you've got $1 to the good if you buy this right now. Meaning that if I bought this at 335 and I didn't have to pay any premium and I could turn around and sell it at 336, I would make $1 times 100 shares or $100. Right? Okay. But I can't buy it for $1. I have to pay $4 times 100 shares or $410 for the right to own this option. So where does the price have to go for me to break even over the next basically 24 hours? It's got to go up from 336 to about 339. Why? Because the strike price is 335. At 339, I'm $300 to the good. In other words, I'm $300 above the strike price. When you take into account that I'm already $100 above the strike price, therefore, this $410 I'm paying, I should be able to sell it at enough money tomorrow before the close to get my money back. Well, what's the big deal? I've just risked $410 to get my money back, and I won't get anything else back. But what if the price goes up more than $3? Let's say the price between now and tomorrow goes up $10. That would include the next hour and 8 minutes of trading up until the time of the close, plus all of the hours between the 9:30 opening tomorrow and when expiration takes place. Okay, so let's just assume, and that's what a lot of people are assuming because they're buying a lot of these options, that Tesla goes up $10 and is at $346 before expiration. $346, but you've got the right to buy it at $335. So you're buying it at $11 less than it is worth, and your option price will reflect that tomorrow because it will be up around 346 in terms of the value of that contract, and you only paid 339, 335, $1 less, the $4 premium, which is the time premium, which is actually about $3.10 more. So basically what we're saying is you've got the ability with a $10 move in Tesla stock from the current level of 336 up to 346 to have this worth $1,100 on expiration, and you paid $400 for it. So $1,100 minus what you paid for it of $400 is $700 and you have only put in 410, and in one day you've made 700. That's with one big assumption, which is that the price goes up $10 between now and tomorrow. So on a very, very volatile stock like Tesla, which was up $50 in one day when Elon Musk made his tweet, and then fell all the way back to 336 from 380 in the intervening days, you can see why so many people play in the option market, because it's naturally leveraged to the total value of what you're buying. Remember, if you actually buy the stock, you're going to have to pay $33,600 for 100 shares. That's if you don't buy it on margin. If you do buy it on margin, you can buy it at half that, but then you have to pay the broker a brokerage call rate for the amount that you've borrowed over and above what you've actually put in. You would have only put in 16,000 some $100. That means you borrowed 16,000, and you're going to pay interest on that borrowed money, which will come out of the value when you go to sell it at some point in the future. But the important point here is you're controlling you're controlling $33,600 worth of stock, and it only cost you $410 in the example that we're using. It will cost a lot less if you drop down here to a $347 strike price. You can buy that, and it will only cost you $51 because it's trading for less than $1 a share. It's trading for 51 cents per share times 100 shares of stock, which is what you have the ability to do. So basically, for $50, you can own this option for one day, and if the price goes over $347.50, you can make a lot of money. Well, that's a pretty big move. That is a move of $11 before the close tomorrow. But you're not paying very much for it, and some people do that. And one way to tell what other people are doing is just look at these volume figures. A lot of people today traded the 340s because we're only $4 away from it. 7,500 options have traded today on that price. I'm going to update because these things all change very quickly. Okay, so 335.90 on Tesla. It slipped back a little bit. Okay, those are the calls. And again, you first of all look at the date. Now what I want you to do is we're going to just go out one more week. Everything's the same, 325s. Here's 1 week later. I want to keep both of these on the screen at the same time. These are the options we just looked at for Tesla that expire tomorrow. Here's the same strike prices, 325 all the way to 342.50, and the next one is 345 and then 347.50. But you get to hold it 7 days longer. Now, the important thing that I tried to stress in our first option program is you don't have to hold it that long. These expire on August the 24th, 8 days from now. But you could buy these today and then sell them tomorrow. Or you could buy these right now with an hour to go in the trading session and sell them 10 minutes later. You don't have to hold an option all the way to its expiration date. You can sell it anytime you want. The same day, the same hour, if you're fast enough, the same minute. And try to play very short-term moves. I'm not going to go into the how you do that, either fundamentally or technically, that will be part 4 or part 5 when we get into what technical tools do you use over various time frames. But what we're doing right now is we're trying to get a mental picture of how this stuff works. And the best way to do it is to look at very short time periods of a very volatile stock. And that's why we're looking at Tesla. So now what I want you to do is we're going to come over here to the 325s that we looked at earlier on the 1-day expiration. And remember, they were bid $11 or $1,125 by $12.10 or $1,210 for the 325s that expire in 1 day. But look at the same ones, the 325s 7 days later. It's $16.25 bid as opposed to $11.25. In other words, this will cost you $1,125 for 1 day and $1,600 if you just tack on 7 more days. Why would that be? Well, obviously, in a volatile stock, that gives you 7 more days of the possibility of the price going way, way up. And so the difference between this 1 day at $11.25 and this 8 day at $16.25 is almost 40% more. You're going to pay 40% more to buy this one call for 100 shares of Tesla just with a 7-day differential. Let's take a look at the next period, which is 15 days. That's up at $20. Well, $20 compared to $16 is 25% more. But you've got another week to go. So the first week cost you 40%. If you go out 1 more week, it's going to cost you another 25% compared to if you just were doing a 1-day option. And we're only out for 2 weeks now. You can imagine what happens when you go further and further into time. Here's the 22 days. It's at $22 for those 325s. Here's 29 days. It's up to almost $25. The differential between the time periods is getting smaller. However, the dollar amount keeps going up and up and up. And what that difference is called the time premium. And you've got to be very aware of what the time premium is that you are paying. We said on these 335s, and we're trading at 335, there's almost a $4 time premium over the next 24 hours. And every trading hour that goes by, if this stays right at 335, this time premium will drop all the way down to 0 in 24 hours. It's going to go from $3.75, or let's just call this $4, down to 0, or your $400 will drop over the next 1 hour until the end of the close today and the trading hours tomorrow in almost a linear fashion. It's not quite linear. It's actually closer to geometric or even exponential in terms of what the curve of the deterioration of that time period looks like. Forget all about that. Just know that what begins happening with time premium as you get closer and closer to the day of expiration is it drops down to 0. The time premium does, not the value of the option, because the value of the option is made of 2 things. One if it's in the money already. For example, this 325 strike price is in the money by $10, right? It's giving you the right to buy Tesla at $325. So $10 of this 1125 bid or 1210 ask, $10 of that is yours to keep as long as Tesla stays at 335 or goes up. And then if it goes up, you've got more to keep, and the time premium doesn't matter. So my point is, on this 325, we've already got $10 or $1,000 when the $10 is multiplied by the 100 shares that you have control over. You've got $1,000 to the good if the price just stays here. But on the 335s, you have no equity. It is trading right where your strike price is, which means this is all time premium. And this will all disappear before the expiration tomorrow. So I've already gone the 30 minutes that I promised. Take everything I just said on the calls and think about it when you go onto your brokerage account. Get this same thing set up for yourself so you can go through the steps I've just gone through and look at the puts. The puts give you the right to sell Tesla at the strike price. So here's the strike price. It stays the same. It's in the middle column. And everything over here are calls, and all of these are puts. So the 335 put, which gives me the right to sell 100 shares by buying one put, will cost me about $3, which is about the same as it was, a little bit more for the calls, which means people are basically slightly more bullish than they are bearish at this moment for Tesla stock because of this differential. But you can just do the same exercise for the puts. Just remember, this means you've got the right to sell the stock at the strike price, and this gives you the right to buy the stock, the calls, at the strike price. Okay, so I am going to go off screen share, and this was, let's just consider this D, E, and F, options D, E, and F. We started with options A, B, C. We called it just options, and this is option 2, but we're going to go through the entire alphabet in 3-letter combinations. We've done the A, B, C, and today was the D, E, F. You've got to do a little homework. I'm not going to do all the work for you by looking at the puts. So go to your E-Trade account, go to your Fidelity account, your Schwab account, anywhere where you can trade and trade options, and go to research or just go to the option page. Type in the name of your company you want to look at, Tesla or General Motors or General Electric or GBTC. That's a good question. GBTC.
And we have a couple of really good questions from.
Okay, that's great. I just want to see if GBTC. No, I don't see anything here.
We should do an entire show on GBTC soon.
We will, because a lot of people are interested. What is this now? This says calls and puts, 10 strikes. Let's just check this out. No, I don't see that. Let's look at calls, 10, Fidelity Research. There are no options. Okay, that's what I thought. At some point, there will be options against many ETFs that will come out. They have not done it for this one. It hasn't been approved, apparently, so no problem. Okay, so I am not screen sharing now, so I can get out of this guy. which I shall do. I can make this guy huge, which I will do. You can do all these things with just a click of the mouse. I don't know if any of you know that. I'm learning it though. Okay, so any questions?
Yeah, you have good ones. And I'm gonna keep the video on you because I like see myself and it looks a little too
No, it's
ridiculous.
cool. Great. I'd love that T-shirt. I'd go to church in that T-shirt.
I can't take myself too seriously today. Okay, so there's a lot of really interesting questions. Great job, guys. What do I want to start with? Any specific strategies that or tactics that you utilize applied to the Greeks? It's maybe for a different show, but if that makes sense for today's show.
Applied to what? The statistics? The Greek?
The Greeks, the delta, gamma, vega, theta.
Yeah, right. Yeah, there's all kinds of them, but we will talk about that somewhere around RS and T. It's very detailed, and we'll do a whole show as we get to the various elements of what you do with these things. I've just shown you the simplest form, buying and selling calls and puts. But as we build this out, and it's important to build it out because it's such an important technique using these things. These are securities. They're called options, but they've got some fabulous qualities about them. It's natural leverage, obviously, without you having to margin. It's done in a margin account, but what I mean is without you having to leverage yourself. It's all very leveraged, but you can control the leverage by all the stuff I just talked about, the time premiums. If you buy things that are in the money, then you don't have to worry about time premiums. You only have to worry about the direction of the trend that you're in. On the other side, if you're in an uptrend and you're buying calls that are in the money means that the calls are, the strike price of the calls are less than the price of the actual stock trading. That's what it means to be in the money. But on a put, just the opposite is true, right? It's not, they both can't be in the money. Only one of them can be in the money. So in a downtrend, you can own a put, which is allowing you to buy at a price higher than where this thing is trading if it's in the money. And then there's very little time premium. So you need to learn to judge all that stuff. And what the questionnaire was talking about is what is the mathematics behind the efficient way of doing that. And there's all kinds of programs that you can use that will give you up to the second analytics, so you don't have to use paper and pencil, and it will tell you the most efficient way to trade these options. It doesn't make you any money, but it's a whole lot easier than you trying to figure it out yourself. Okay.
Thanks, Ty. I'm gonna ask a couple more. Just say if if it's a good one for today or not. Also, did you used to use paper and pencil?
Yeah, for years and years and years. I did have a Bomar calculator back in the early 1970s when I was going to getting my master's degree in business, which basically had 10 buttons on it, plus a division, multiplication, and that was it. It didn't even have percentages or any kind of analytics on it at all. And I think it cost $199 at the time, and I could do it much faster with paper and pencil.
I love it. Okay.
But even neater was back in the 1960s. My best friend his father was the head of high energy research at Argonne National Laboratory. And we went in there with him. We were in high school at the time, to his office, and they had this calculator. And it wasn't an electronic calculator, it was a mechanical calculator that the scientists were all using. At the time, they still used the old, they're called slipsticks. If none of you know what that is, you can look it up. It's also called a slide rule, but cool people back then called them slipsticks. And But some people could use these mechanical calculators where you punch in your numbers and then you pull down on a thing and it makes all kinds of whirring noises and stuff, and then you get an answer, which was the coolest thing we had ever seen. And this was one of the first places that was using it, the national laboratories. The other thing they had was the first microwave ovens where you could throw in, these packaged hamburgers, which we thought we had died and gone to heaven because nobody had even seen them before or heard about them. But some of the laboratories were starting to use them. Okay, I think I'm getting off topic.
I just I realize I'm wearing a wolf shirt and you're talking about doing math and pen and paper with slipsticks.
Right, exactly.
I think we should.
We are so cool.
Okay. Okay, sorry. Why are options so liquid?
They're not. They're very illiquid. If you remember, we looked at that first Tesla option, only 62 of them traded all day. So if you wanted to try to buy 100 of them, a large number, or even 10 of them, when only 60 traded in 8 hours, you're going to move the bid and the ask. It's not liquid. I showed you another one. There were 7,000 that have traded today. Well, you can put in 1 or 5 or 10, and that's a lot of volume. 7,000, remember, is times 100 shares. So 7,000 is the same as 700,000 shares that had traded. Well, 700,000 shares of Tesla is nothing, but it's enough that you can get in and out close to the bid or the ask if you're buying or selling with that kind of volume. You can't at 1,000 for the day or 500 or 60 like we looked at. So they are not very liquid. But if you go out a month or 2 or 3, you can go out a year and buy options a year from now. They're called leaps because they're longer than a year. Some are 2 years long. There's even 3-year leaps where you can buy options on Tesla at, say, $350, and you are going to pay a bloody fortune because it's so volatile. The time premium is so long that you're going to pay enormous amounts of money. You can look that up, as I said, on your own by looking at your own brokerage firm and just go way out and take a look at what the time premiums look like. But always look at the volume because they are not liquid unless they are. Most of them are not liquid unless it's a heavily traded stock and one that is very recently volatile. Then you will see a lot of volume. You check the volume first. Now, you can use limit orders, just as you do on stocks or on Bitcoin on certain exchanges. You can use a limit order and just wait for the price in real time to hit yours. And then the liquidity doesn't matter. But you've got to make that limit order right around the market price right now if it's going to go off. Otherwise, you could miss your entire investment. So that's kind of GHI, option GHI. We'll get into what to look for in terms of volume and open interest and the liquidity factor when you're making your decisions. But let's keep it fairly simple. But that's a great question.
We have a Hyperwaver question.
Great.
So I don't know why I always get reverb. Sorry, guys. I even created sound panels everywhere. Actually, my brother did. Okay, I have a hypothetical scenario I'm hoping to get Tyler's opinion on. So I'm just going to read it straight. If an asset is in a hyperwave and preparing to test a phase line, would it be a solid strategy to place a call order for that asset? And he included an example. An asset is currently trending down with a price of 180. The phase 3 line is at 170. I decide to place a call order for that asset at 190 with the belief that it would bounce sharply upwards off the phase line.
Absolutely. One of the most exciting things about hyperwaves There are a lot of very exciting things about hyperwaves. Our hyperwave research group is finding them and is experimenting with their own accounts, trying option trading and a lot of other things. But the single most important thing about a hyperwave is it tells the future. It doesn't tell you when something is going to happen, but it does tell you that something is going to happen. Remember, anything that's in a phase 1 will probably never become a hyperwave. Anything that's in a phase 2, the chances are only about 15%, 15 out of 100 examples that will become a hyperwave. But once something is in a phase 3, 85% of the time, it's going to go all the way through phase 4, 5, 6, and 7. So now all of a sudden you've gone from a 0% probability to a 15% probability to an 85% probability, with the best, the cherry on the top is once you've gone from a phase 3 to a phase 4, you've got a 100% probability. Now let me change that to 99% right now, because I know our research crew will find some that never made it. It's just out of the first 300 that I identified, once they got to a phase 4, it was going all the way to a phase 5, 6, and 7. 100% of the time. Let's knock it down to 99 and see what happens. See, and any of you can look too. Try to find a hyperwave that went into a phase 3 and into a phase 4 and did not complete the entire hyperwave. That means you are foretelling the future. It is deterministic that at phase 2, you've got approximately a 1 in 8 chance that you're looking at a hyperwave. But in phase 3, you've got 85 out of 100 chance that this is going to be a hyperwave. Not 50-50, 85 out of 100, 850 out of 1,000, 8,500 out of 10,000. So the next 10,000 you look at, if you jump in every one of them, you're going to be right 850 times out of 1,000, 8,500 times out of 10,000. You'll make a ton of money. Okay, but once it makes that next move from a phase 3 into a phase 4, it tells you so much information. And it's not a quiet suggestion. It's screaming in your ear. Don't be a fool. Take advantage of these statistics. Let's just say you've accelerated from a phase 3 into a phase 4, and you believe you're early in a phase 4. You know that it's going much, much, much higher than the point at which it switched from a phase 3 into a phase 4. What you don't know, and that's what our researchers are struggling with in real time, is it possible that what you are interpreting as an acceleration into a phase 4 is just a movement up from the phase 3 line? And it will come back down to the phase 3 line because you were never in a phase 4 yet? And the answer is absolutely yes. And that's the perfect time to be using options. When you're going from what you thought was a phase 3 into what you believe is a phase 4, and you get a sharp acceleration away from the phase 3 line, that's a great time to buy a put to allow it to drop back down to that phase 3 line. Now, what happens if you do that and you really are in a phase 4? Well, that's great, because if you really are in a phase 4, you're not going to drop all the way down to the phase 3 line. You're going to hold the phase 4 line, and you're probably not buying very far above that line. Therefore, it's a very low risk entry to buy a put if it gets too far above the phase 3, and I would wait for it to accelerate above what you assume to be the phase 4 to a point high enough above the phase 4 that you can stomach a drop back down to the phase 4 line, at which point, what are you going to do if it holds? Clearly, you are going to get out of your put, but you're going to put a call on right there, which is what your question asks. Does it make sense as you get down, you're dropping down to a phase line, which is still moving up, that you should be starting to think about buying calls? If I wanted to buy 10 calls, I would buy the first one some 10% above that phase line. I would add 2 or 3 more at 5% above the phase line. And I would buy the last 5 if it came down and touched, or intra-week, for example, broke down through that phase line, because it is very probably going to turn around and go skyrocketing back up. And now you've got 10 positions on at 100 shares each, or 1,000 shares of this particular thing that you know is going much, much higher, because that's what happens with hyperwaves in the phase 3 and phase 4s. Same thing on the downside. The greatest amount of money can be made because the phase 5 tends to drop quicker than phase 4 went up. It can be over very, very quickly. And the drop can be anywhere from 20 to 50% of where the price started. And it can happen within a day, a week, a couple of weeks. You need the break of the phase 4 on a weekly closing basis. And I'll just give everybody a hint. Take a look at Netflix, draw some lines yourself, and come to a conclusion of what you think of where Netflix is. I'm not going to make any recommendations. I'm just giving you a hint of something interesting to look at having to do with the topic we're talking about today.
All right, Ty, I think that's a great place to end.
Okay, that's great. Well, thank you all very much. We ran over, as I always do, but I hope it was interesting. And we're going to start some Consensio ABCs, and then we will go through the alphabet with that, getting deeper and deeper into how to use it. I think I've already covered most of the hyperwave kind of stuff I want, or as much as I want to make public at this point. We'll have some announcements about that in the future. But this is a teaching channel. This is trying to introduce you to new concepts and technical analysis that other people don't cover, because it's basically proprietary. But I think you can begin seeing some tremendous usage for what we're talking about. And with that, thank you very much, Leah, and thank you, everybody. You're muted.
Okay, hold on one second. Can you hear me?
Yeah.
Okay, just before we run, just one short note. I don't think you need to bring up the charts, but a short note on Bitcoin.
Oh, yeah, sorry. Let's bring up the chart. I'm going to go boom, bada, boom, bada, boom, bada, boom, bada. And then I'm going to get rid of this, and then I'm going to go over here, and then I'm going to go over here. Okay, here we are. We're sitting at 64.05. Let's go to the weekly chart. The weekly chart broke down through the stop and reverse points, and now we've got to get all the way up to 85.34 to go positive again. That to me is the single most important technical thing going on right now, which I have already explained. The most important thing going on for Bitcoin right now is it's in the down cycle of a hyperwave. That's number one. That's what you need to understand when talking about Bitcoin more than anything else. You either accept it or you don't accept it. If you don't accept it, that's fine. I think the longer you work with hyperwaves, you'll understand you're missing a huge opportunity. in Bitcoin land, a lot of people are very resistant to the idea that this thing can ever go down. And that's why people are writing it all the way down. But remember what I just said about the probabilities. Once you have gone through a phase 1, a phase 2, a phase 3, and a phase 4, 100% of the time after the phase 4, you get a phase 5 break, you get a movement back up, which is called phase 6, and then the long, slow process of a phase 7. I can't make it any simpler than that. We've got hundreds and hundreds and hundreds of examples of this. Okay, so it's important. The second thing I think about is these stop and reverse points. They tend to be under the price all the way up in a bull market, and they tend to be over the price all the way in a bear market. And that's why this 4-week period that gave us buy signals on the stop and reverse point were so important, because they were trying to say that maybe the 6,000 level is going to be able to hold. That came to a screeching halt this past Sunday. And we've got to get up now all the way to 8,500 to go bullish again. Until that, this is what you're looking at. This little dot right here says that this is continuing, which means that the long-term trend of Bitcoin is down. It is not up. And okay, enough said. I'm going to take that off, and I am going to replace it with the Bollinger Bands, which are saying the same thing to me. Number one, you're in a hyperwave, and you're in the down part, the phase 7 of that hyperwave. Number two, you've got the stop and reverse point, which is the second most important thing to consider. The third most important sometimes is the Bollinger Bands. This time it is. To me, this is very close to the stop and reverse point of the story it is telling about the future. This is telling the story that we tried to get back over the middle band 1, 2, 3, 4 weeks, 5 weeks. I'm going to call this 6 weeks, 7, 8, 9 weeks. We just finished a 10th week. 2 of those were able to penetrate. The first one closed above the middle line. The second one closed below the middle line. And neither of them, the entire candle, was above the middle line, which is my test for the ability for Bollinger to say we're going back up to the top line. It did not do that. So what I expected to happen is happening. The price is dropping from the middle line back to the bottom line, which comes in right now somewhere around my phase 2 line. This looks to me like 5,240 or 50 compared to my phase 2, which is now pushing 5,300. In any case, there's a lot of reason to believe we're going at least down to that level. I'm going to now look at moving averages, which is my way of looking at Consensio. And Consensio is saying the long term is down. The intermediate term is flat to slightly up, and now flattening out more because the short term is down. We now have the short term below the intermediate term, below the long term, and the price below all 3 of them. That is my perfect definition of a bear market applied to anything. Netflix, Tesla, the NASDAQ 100, the Dow, gold prices, silver prices. That is the definition of a bear market. Now, you let your imagination go crazy and come up with all kinds of things that might happen in the future. We're not looking at the future. We're looking at the evidence as of 3:34 today, a half an hour before the close of the US markets, and just about 4.5 hours before the close of the Bitcoin market in terms of charting. Okay, I'm going to take that off. I'm going to just look at two more, the RSI at the bottom. It is actually curling up a little bit again, but not from an oversold position, just from the 42 area after coming down from above 50, 52. It is curling over a little bit because we've had a little bit of an upswing, a little bit of a green market. This is still very negative to me because it needs to overcome everything that happened in the past in terms of these overbought signals. We need to get oversold. So I consider this negative. We need to drop from the low 40s by 20 or 25% in terms of the RSI, just to touch the 30 mark. And I believe we're going to see it down below 25 and maybe even 20 before capitulation takes place on the downside. One more, the MACDs were negative, are negative, staying negative. There's nothing positive going on there. It's all flattening out. But these last two marks on the histograms are bigger, in other words, more negative than the two before them, which means over the last month, it's getting better. If you come up here and look at the 4 candles, you can see why that would be. Because after this run up that lasted 5 weeks, it petered out and now it's beginning to fall again. Now, can all of this change with price action starting tonight and tomorrow? Of course, but it has not changed as of this vlog, as of 3:36. And that is my feeling about the future, where I believe Bitcoin is and where I believe it is going. And with that, I am going to turn it back over to Leah, and thank you for reminding me that we needed to talk about that.
All right, perfect. Everybody, thank you so much. Have a silly day. Have a great day. Thank you so much for watching. Ty.
Great. Thank you very much, everybody. Bye-bye.
Bye.